Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Report and, of course, the Banking on Profits newsletter coming from you. And I'm almost reluctant to say a very pleasant day down here in Central Florida. I know folks up in the Northeast and the Midwest are just getting hammered with cold temperature and blowing snow and all kind of crazy stuff today. And I feel your pain. It was barely, 65 here yesterday. Got quite chilly. Had to go to a long sleeve shirt. But enough of that. It was a strong week for the stock market. Sat down and looked at the weekly returns for this week, and the S&P 500 was up a little bit over 2%. The All World URTH index was up 1.64, and our quiet, sleepy little community banks index, the QABA, was dragging behind the pack at about a 0.36% gain for the week. Now we don't really base a whole lot on week-to-week fluctuations. We're still really wildly enthusiastic about the smaller banks. Now, I didn't really see any reason during the week for strong gains in the markets. There were no wondrous profit reports or great driving economic announcements. So I actually sat down with Barron's this morning and kind of flipped through to see exactly what folks were saying about the market in the last week and what those strong drivers that gave us a nice 2% gain. That's a solid gain for a 1 week period of time. And here's what I came up with. Was the Ukrainian ceasefire, because everybody actually believes that thing's going to hold. I really don't think it holds for very long. I don't think anyone else believes it either. Apparently, in the discussions between Greece and the ECB, the Greek prime minister and financial minister, maybe they used more polite language to tell the Eurozone exactly where they can stick austerity, but they have not reached any sort of lasting agreement. I'm told that they have until Wednesday of this week to really get some kind of deal hammered out. Everybody's positive that they will. Who knows if Greek may decide to leave the euro. That's going to be complex. Real interested to see what happens in the week ahead, because we do have that nice position in Greek bank stocks. But don't really see that as a reason for the U.S. markets to be up 2% on the week. I can't imagine that we have that much financial exposure to Greece. Rising oil prices, of course, lifted energy stocks, which is a significant component of the S&P 500. We didn't mind that at all. We've got, some nice little energy stocks, some of them that had enormous increases during the week. They're all very small positions, and the ones that had the biggest gains are the ones where we bought early last year and we're really getting creamed on anyway. But it did help lift the portfolio overall for the week. Now, here's what I'm not really hearing. There's nothing in there about this strong earnings growth or strong economic conditions. I'm hearing anecdotal evidence for stock prices being higher. Couldn't really make you a case for a strong market on any of those factors. Digging in a little deeper, so far about 86% of the S&P 500 companies have reported earnings, and what we've got so far is really good profit growth, 6.3% year over year. But let's work our way back up the statement. You've only got 1.4% revenue growth. And so once again, we look at this. One of the biggest drivers of earnings, by the way, is Apple. As we look at this is all the same game we've seen for the last few years. This is not positive revenue growth and people selling more stuff. This is all buybacks and illusions, in my opinion. Technology is contributing some at the cost of some jobs, by the way. But most of this is financial engineering and stock buybacks driving profits higher. Don't know how long that can continue. Don't think it's real healthy for the market or the economy. But nobody's really asking my opinion. So not sure why stocks are up to such a strong start. Really just don't think that this type of earnings and revenue performance deserves much higher multiples than we're already putting on stocks. So anyway, the big news this week, we had a great discussion with Ted Peters. He, of course, is the now retired CEO of Bryn Mawr Bank up in Philadelphia. Has done a fantastic job over the last 14 years as CEO of that bank. The stock didn't even really fall much in the credit crisis. They've just concentrated on growth, on efficiency, on loan standards. The loan book has never really gotten out of control the way some of the smaller banks did when things were at their worst. He started and sold two other banks in his lifetime. He's had a 28-year career as a banker. Now he's retired at a relatively young age, and he's decided to open a hedge fund to invest in, you guessed it, community banks. He's sees the same merger wave that we do. He points out that there's 279 mergers this year. Folks think that's going to be 350 or more bank deals this year. Mr. Peters agrees with that. And I want to point out that according to Deloitte and Touche M&A study on banks that just came out, of those 279 deals, only 5 involve targets with greater than $500 million in total market cap. So all the merger and activity action is in the smaller bank stocks in the early stages of this game, and it's going to pick up substantially next year, according to the folks who study this type of stuff. We're in pretty good shape to take advantage of that. We've got the community bank stock portfolio. That portion, because I consider the two baskets, but that portion of our assets is just about 100% invested in a whole bunch of quality community banks that we bought below book value, and most of them have stock activist involvement, so we're pretty excited about that. The other thing that I was fascinated to review this past week was Roger Ibbotson of Yale University recently did, 2013, but I just was made aware of it for the first time. I don't know how I overlooked this study because it's one of the more important ones out there. He looked on the impact of liquidity and stock returns. Now, everybody thinks that one of the biggest advantages to investing in stocks is the fact that they are very liquid investments. In fact, exactly the opposite is the case. The illiquid stocks trounce the liquid stocks performance from 1972 through the end of 2011. What's really interesting is how consistent the performance is. Illiquid stocks in general outperform liquid stocks. Illiquid growth stocks outperform liquid growth stocks, and illiquid value stocks outperform value stocks. When you start to mix the metrics up, this gets really interesting. Over that period of time, 1972 to 2011, the least liquid value stocks earning you about 18% a year. That's a super return. I'll take that any day of the week. Now, the liquid growth stocks are at the other end of the spectrum. The return on those things over the same time period is about 2.4%. Now, let me ask you something. It's the illiquid value stocks offer the highest return, and the liquid growth stocks offer just a horrible return. They log the market by a tremendous percentage. They fall behind. Where are you focusing all your time, interest, and money? I'm willing to bet you that for most of you, it is the very liquid growth stocks, exactly where you should not be, according to Mr. Ibbotson and his results. And by the way, what does a illiquid value stock look like? A community bank stock trading for less than book value. Anyway, we did go through the big three, 13Fs. All three guys filed early. That would be Joseph Stillwell, Lawrence Seidman, and the folks at PL Capital, the leading bank stock activists, in my opinion. We went through them, found that they're still buying in small banks, trading right around or for less than book value. They're finding stuff to buy. So are we. They're really putting pressure on a lot of these banks to get profit margins up or sell the bank outright at some point in the very near future. Mr. Stillwell in particular, I went through his track record. He's got a really high conversion rate of these banks getting sold. He's been in 55 13D filings over the last since 2000. 13 of those have been sold. Another 11, they took measures to build shareholder value, and he exited at substantial profits. And he's gotten board seats on another 7. He lists all of that activity in every 13D filing. So these guys have huge, successful, long track records of forcing good things to happen at the community bank. So it just makes sense for us to get our money in right alongside theirs, as long as we're not paying any sort of premium to book value. When we sent our buy list out this week, we had over 20 stocks, once again, trading below book value with a strong activist investor involved in the stock. Now, the filing date has been pushed back all the way till Tuesday because of the holiday tomorrow. But we've still got a lot more of these community bank stock activist investors to report. Clover Capital, Corsair, Patriot Financial, FJ Capital. Michael Price usually has a couple of these little banks filtered in there. So a whole bunch more of potential ideas coming up in the week ahead as we review the rest of these 13F filings. Now, I picked up the New York Times the other day on Friday and just kind of flipping through it. And there's Mark Spitznagel with his annual prediction of a 40% or greater stock market decline. I'm kidding about it being every year, but it has been for the past couple years, as he correctly points out that the Tobin's Q ratio, and think of it as the U.S. economy's and corporate economy's price to book value ratio, is at very high levels. And in fact, when it's reached these levels in the past, and it's 1905, 1929, 1936, 1968, 2000, and 2007, when it's gotten up to this level, markets crashed by, are you ready for this? 19%, 85%, 36%, 29%, 44%, and 50%, or about an average decline of 43% every time it's gotten up this high. So that makes you think, oh my goodness, it's serious bomb shelter time. We need to run, hide, collect cash, gold, bullets, green beans. Well, here's the thing. This is not a precise timing indicator. Has worked. I'm just going to tell you, every time it's gotten up to this level, prices have eventually, and the key phrase there is eventually, collapsed quite a bit. It can take a long time for the markets to correct in response to this overvaluation of corporate assets. In fact, if you look at the 2000 pullback, this market probably got to current levels, the Tobin's Q ratio, got to right around where they are now, in 1997. You had almost 4 more years of craziness and ascending stock prices before the market finally turned around and headed the other way. So we're not going to use this as any sort of precise indicator, and we're going to focus more on the fact, I'll just take the last 3. After this thing peaked in 1968, this of course led to the 1970s decline, which was horrific by any measure, as was the dot-com bubble, as was 2008. All 3 have one thing in common. Had you bought following the crash, even if you didn't get the absolute bottom and you had to scale down, a decade later, you were, well, we can't do that on the 2008 because we're not quite a decade out. But buying into those crises and crashes made folks an awful lot of money. The 1970s was the start of really Warren Buffett and Berkshire Hathaway's becoming just a tremendous company because they were able to acquire so many assets at such ridiculously attractive prices during that sell-off at the time. Lots of money's been made by lots of people buying into market crashes. By lots of people is a relative term, as most of us don't have the fortitude to do that. We're getting up there. There's not a lot of cheap stocks. The Tobin's Q ratio is quite high historically. It's only been higher one other time during the dot-com bubble. That does not mean we go into the bunker, however. We're just going to use a little extra caution. We're going to focus on those stocks that are safe and cheap enough to buy, because there's not a lot in the basket that is the deep value portion. We've got a lot of cash. It's a little different story with the community banks. So we're going to use caution, and community banks have not seen Hetty Green, Andy Beal, or Mr. Womack heading for town to buy stocks just yet. So I don't think we should be too aggressive in our approach to the markets either. Our turn is coming. It will get here, and we'll be able to, hopefully buy into a rapidly declining market. Hasn't happened yet. We're not going to predict when it does. We're just going to keep ourselves in a position to react when that does happen and get money to work on very favorable terms. So anyway, 4 days, guys, till pitchers and catchers report. Getting pretty excited. Going to try to get to a few spring training games. I usually try to get to the Orioles and, of course, the Washington Nationals. And the Washington Braves are right down the street here at the Disney complex. So hopefully I'll get to 1 or 2 of those, and I can see Nick Markakis play in a different uniform for the first time in his career. Anyway, that's all I've got for you down here in Central Florida today. This is Tim Melvin of the Deep Value Report and Banking on Profits newsletter. Have a great week, guys.